Welcome to the Probasco podcast. I am Claudia Williamson, the Probasco Chair and Professor of Economics at UTC, and this is our second episode, and I am happy to be joined by Brandon Cline. He is the John Nudi and Edie Dowdle Professor of Finance at the Department of Finance and Economics at Mississippi State University. He is also Director of the Institute for Market Studies. Welcome, Brandon.
Well, thank you, Claudia. It's a pleasure to be here today.
I am very excited to have Brandon joining us. He is my former colleague at Mississippi State, and we are still co-authors. But today we're not going to talk about our co-authored research. We're going to focus on Brandon's research on integrity and corporate governance. So, Brandon, you had a recent publication in the Journal of Financial Economics, and I would like to start talking about that work and kind of explaining what integrity is. Why would you even start to research it as a finance professor, and explain to us why you would think that this would matter in terms of trying to understand corporate governance?
Okay. I guess the impetus of the idea came from there has been a long-standing literature on trust and integrity. And the problem with that literature is hard to empirically measure integrity, right? We can see lapses of that in some cases, but whenever you get to the firm level, we have experiences of companies that tend to be more trustworthy and people that tend to be more trustworthy, but empirically it's tough to differentiate those types of characteristics. The idea of this paper came from looking at personal, what we call indiscretion. So basically it's individual decisions that managers, typically CEOs, CFOs, top-level management, sometimes members of the board, that they make on their own time.
Okay. So whenever we were thinking about the actors within a firm, this could be technically anybody that's associated with the firm, so not just the CEO. Is that correct?
No, not just the CEO. A large portion of the sample is CEOs, and the effects that we find from our study tend to be magnified the higher, particularly for CEOs. But no, it is all management.
And so what's the idea behind, where was your logic when you're thinking about their behavior outside of the firm?
Well, it's hard to disentangle. So you have companies that engage in bad behavior, and no doubt it's bad for the firm, particularly when they get caught. And so you've got cases of WorldCom and Enron and all kinds of accounting fraud. You have class action lawsuits. You have these cases of bad firm behavior, and we know that that's bad. But it's hard to differentiate what's being driven from integrity, lapses of integrity, versus what is just driven from the fact that they got caught. So in other words, typically these types of things involved, if you're involved in accounting fraud, for example, you have to go back and restate your earnings. You have to pay back. Usually there's going to be a class action lawsuit. Since there's going to be millions of dollars of cash flows, they're going to exit the firm. And that's going to make it appear as though the market is punishing lapses of integrity, when in fact what the market may just be responding to is the fact that the firm is now bleeding cash. And so we wanted to be able to better differentiate what the price of that lack of integrity is. And we feel like our setting, by looking at personal indiscretions, we're able to divorce that from the reaction directly to the firm and better assess what the market pricing of integrity is.
Okay, that sounds really interesting. So how do you measure personal integrity?
Well, we follow executives around for months and months and months, and we observe them in bad behavior.
Okay. What?
We don't really follow them around, but yeah, it's kind of like that. And so basically, we hand collect data of executives that's publicly announced. So it's important that it be publicly announced because we wanted to see what the market reaction of these things are. But it's cases like the executives are caught with drugs. They lied on their resume. They are caught plagiarizing or tax fraud. They're caught with prostitutes. Personal decisions, again, all of them completely unrelated to the firm, but it signals you would see a lapse of trust, maybe, in some cases of dishonesty, executives that are engaged in public affairs, those types of events.
Okay, so let me think this through. If we have leaders maybe the personality type to drink or do illegal drugs or, be caught with a prostitute, as you said, that's not necessarily meaning they would be a bad manager.
No, that's true. In fact, there is theory that suggests that you should want these. On average, we know that executives tend to be more risk averse. Everything they have is tied to the company. And, there is theory that would suggest if you find executives that have a more risky personal life, then they might have a higher appetite for risk at the firm level, which tends to be good for shareholders. And so, no, you're exactly right. There is logic that would suggest maybe these are good things. On the other side of the coin, though, the counter argument is maybe I do want you taking risks, but these things signal more than just risk taking. It also signals dishonesty. And so the logic in the other direction is that you're willing to lie, cheat, and steal in your personal life, then you may have a propensity to be willing to do that at the corporate level as well.
Okay, but there are rules to govern the corporate behavior, whereas we have social norms and, maybe if you're married and you're cheating, then there's a contract there that you would be breaking. But in terms of maybe they're not lying. So I believe one of your other categories was violence.
Okay.
Right? So kind of just give us some thoughts on the differences in terms of the different types of indiscretions.
Okay. So violence, as you said, is one of them. We have 4 categories. There's multiple that fit within this, but the 4 categories, one is violence, and so a lot of that is domestic abuse. Sometimes it's assault at work or in a public place on someone else. Anything that you think of that would be violence related. Sometimes it's even child abuse.
Wow. Okay.
Fit into that category. We have also sexual misadventure. And so that category tends to be breaking of, as you were mentioning, some type of other contracts, right? So in some cases of harassment, if it's with outside the firm, rape, or if you're cheating on your spouse, would all fit into that category. The other 2 categories were dishonesty and substance abuse. And so you can imagine substance abuse tends to be drugs and alcohol predominantly. The dishonesty involves resume fraud, tax fraud, and in some cases, plagiarism.
Okay. So then what happens? What happens when a manager or CEO or someone that serves on a board of a firm gets caught lying, for example?
Okay. So our main question is, does the market care? And so the good thing about financial markets is you get an immediate reaction to whether it's good things or bad things. We can measure how good and how bad the events actually are. And so we do what are considered event studies around these events. And so as soon as for example, you get caught plagiarizing, there was a CEO who actually wrote a manual of ethics for his company.
Oh my goodness.
So his own corporate ethics book that he self-published within his organization.
Oh, wow.
And guess what?
It was plagiarized.
It was plagiarized.
Wow.
Turned out it had been written, I think, in 1949, word for word. So you have some really weird cases. So when this is publicly known, we want to observe how do shareholders respond, particularly does the price go up or the price go down? So consistent with what you were hinting at earlier, perhaps it's a good thing. If it's signal risk-taking and we know that shareholders tend to want their CEOs to take on more risk, then maybe stock price goes up. Consistent with our theory, we find that integrity is negatively priced. When that is publicly announced that you are engaged in some type of dishonesty or some type of violence or substance abuse, on average, it doesn't happen for every single case, but on average, stock price goes down.
Okay. So is this just a short run effect, or did you differentiate between the immediate effect and longer run effects, or is it something that you can, attribute to this particular event?
Yeah, so we have what we call the short run analysis, which is 3 days around the event.
Okay.
And on average, just in those 3 days, the typical firm loses almost $2.5 million on those 3 days.
Yeah.
When it's the CEO, that the losses are much more, almost $4.5 million when the indiscretion itself was committed by the top person, the CEO who's in control.
So what's interesting about this type of research is it seems that it's allowing you to have additional insight into possible firm behavior, and that's not what you're directly measuring.
And that's spot on. I think that is exactly what I think the practical application of our study would be. We can usually identify fraud. You're right, there are rules. We have accounting rules. We have monitors, auditors that analyze this type of behavior. And companies, you can think of them, the WorldComs, Enrons, Tycos, and the list goes on of these companies that ultimately they are caught. The problem is by the time that they are, everyone's lost.
Right.
Their suppliers, their customers, their shareholders have all lost drastic amounts of wealth. Their employees are fired. Their retirement is gone. And so the idea of this, at least one use of this, is if we can see these signals within the personal behaviors of these executives, it gives me information as a shareholder what type of company I would like to invest in. Or as a director, we can have some signal of what other types of behavior at the firm that could be going on. And we do some of this type of analysis. We look at future events. So we find that companies that have executives that are involved in these personal indiscretions have a much higher likelihood of, in the future, being indicted for fraud by the DOJ, being named in a class action lawsuit,
Wow. Okay.
engaged in earnings management, so these other types of illegal behavior. And so our thought is that this gives us a window of insight into seeing what may be further down the road. And the hope is that shareholders and directors and monitors can help prevent this type of behavior from occurring before it is at the firm level and everyone loses.
Yeah, that's a really interesting kind of policy implication in terms of academic research being extremely relevant and important for individuals, not just shareholders, but people who care about the world that we live in can use this type of research into kind of understanding which firms to support or, which companies to invest in or even buy from. So one other thought I had is...
One thing I will add to that, too, some of the subsequent analysis of that paper, you mentioned which firms to buy from, or we also looked at other types of relationships, at the firm level. So, for example, partnerships, major suppliers, we have data on who, and when these indiscretions are announced, I guess the first reaction is shareholders do care. They punish the firm, both short run and long run. But there is a mass exit of these other types of relationships.
Oh, wow. Okay.
And it signals the importance of trust in doing business. There's so many things that you can't contract over.
That's true.
That as a supplier, maybe you're not doing anything directly to me. Price hasn't changed. All I know is that you're someone that I have to pay a little closer attention to. And we do see that exodus.
It raises the transactions cost of interacting with those individuals within that firm.
Exactly.
So does the executive get fired?
Well, what's interesting is in many cases they do. In some of our indiscretions, there's no choice. And so in some of these, the executive gets arrested, right? They're in prison. Or so in a lot of those cases they do. It's interesting the firms that do and those that do not. And some of our subsequent analysis, and this actually didn't appear in the publication, but whenever we observe, I told you the market reaction. So on average, markets punish. As soon as it's announced, stock price goes down significantly on that day. If that executive is actually terminated, we see a significant reversal in that stock price. So in other words, you can imagine this chart, it's announced, stock price tanks. But if the company signals, hey, we're going to do something about this, we're going to discipline that type of behavior, it doesn't completely remedy it from the stock price, but almost immediately over half of that deterioration is won back. And so you see that integrity both ways. The market's pricing it, but when they observe that it's bad, but when the company is signaling to the market that we don't put up, we don't tolerate this type of behavior, then there is a reversal.
Well, that is, in some sense, I guess, refreshing from the perspective of believing that it really was that one individual, and when the firm reacts to eliminate them, that it's at least ex post they're cleaning up, but perhaps then the reversal was indicative of, we just kind of found this out too about their behavior, and we don't want that type of behavior within our company.
It's refreshing, too, to see that the market is disciplining.
That's right.
With the stock price, the labor market is disciplining. We do see turnover, not perfectly, but the market is imposing a discipline mechanism on these executives that are, we'll call them bad. At least they are signaling that they don't have the integrity that we would hope that they would have in leading the companies that we invest in.
So do you have any sense, or did your analysis, was it able to sort along industry in the sense of certain types of industry maybe have a propensity to have this type of leader, but then it's less, like the market cares less in those types of industries? I'm not sure if I asked that very clearly.
The effects, I think I understand your question. So in general, there tends to be a fairly standard negative reaction across industries. But you do find some differentiation. Two things. One, of our subsamples that we discussed earlier, dishonesty is the strongest.
Okay, that makes sense.
There are effects in some of the other, it does make sense, because at the end of the day, I don't necessarily personally know you, and I may not really care if you're with a prostitute or whether you have a drug problem even, but I do care if you lie to me.
Yeah.
Particularly as a shareholder, that's what matters most, or as a supplier or as a major customer, you have to be able to have that trust. And so I think, we mention a lot of integrity, but I think a more micro argument would be is trust really does matter.
Yeah. And so along the industry lines.
So, what is interesting is, this was a later add to the paper, but we look at, there are industries that are what we call shady industries.
Okay.
There are industries that are just known for there being more corruption. That's the way that business operates. There's more corruption. There's no breaking of rules and regulations. Some of it's minor violations, EPA or FDA types of regulations. And so we do categorize. We split industries into what we call shady and non-shady industries. And the expectation is that if you operate in one of these shady industries where cheating or corruption is maybe even necessary to survive, then at least it wouldn't be surprising that your CEO is a little shady as well. And maybe it's even beneficial. And what we observe is that in those shady industries, there is still a negative price reaction, but it's not nearly as strong as it is in those industries where that's not the norm.
So could you give an example of what would be a shady industry?
Well, in our analysis, it was just those that had higher levels of corruption.
Okay, I see. So it's not what type of business they're in.
You could imagine if I'm in a business of
so oil,
porn.
Well, okay, or sin stocks, or
yes, exactly.
Right, the ones that are classified more as okay.
But we don't subjectively classify it that way. We empirically identify it based on breaches in what you're supposed to be doing. Probably not a perfect classification, but at least we think we're able to get to the point of, okay, whether you expect it or whether you don't, is there a difference? And our analysis says yes. If you didn't expect it, to the ability of our to differentiate that, we're able to see that when it's unexpected, it's strong.
So then I'm curious if you could go back and look at the data to see, because it would be about expectation. So say you're investing in the porn industry, right? You're a shareholder in a company that makes porn. Then you're probably not going to be shocked if the CEO of this company is caught with a prostitute. Yeah, exactly.
I know, that's right.
But I guess back to your point about lying, still as a shareholder, you may care. It's not about the prostitute per se, but if you've lied or you're cheating, then that sends still that dishonesty signal that shareholders would ultimately care about.
Shareholders still very much care whenever you report at the end of the quarter and the end of the year. You talk about your projects and your expectations and your financials, what those numbers are, whether they can believe those or not. That is of utmost importance.
Yeah, that's really interesting. So then whenever we're thinking about this and you're, again, trying to use this information as to insight into what is going on inside the firm, are there other aspects or other monitors that are paying attention?
Yeah, so So, for example, auditors. So we have a follow-up paper that's under review. We have an R&R from the accounting review.
Oh, wow. Congratulations.
Thank you.
Those are hard to come by for those who aren't aware.
In that analysis, so we basically step back away from this. And so kind of the takeaway from the first paper is that the market cares, shareholders do punish. And if that is the case, then there are people that are charged with watching this type of behavior.
Right, okay.
And so, for example, if you remember with Enron, Arthur Andersen, it doesn't exist anymore. That was the auditor of Enron who basically went down with this accounting fraud as well. So they were charged with, they should have known. Most reasonable accounts would say that they did know. And so the auditors do care, they should care, and their reputation is attached to that company. And they're charged with doing just that. And so anytime there's changes in financial information, there's a whole section on managerial integrity, tone at the top, whether or not you think managers can be trusted. And so our logic is that if that's the case, then auditors should be picking up on these things beforehand. And granted, if our ability to detect what the public announcement is, probably the auditors wouldn't, that's their first ability is into seeing these things as well. And so what we did instead is we looked at how the auditors responded to these observations of lapses of integrity.
And what did you find?
3 things. One, that their fees go up. And so
Interesting. So do they stay as the auditor with that firm?
On average, there's a very rare occasion for the auditors to sever the relationship with the company, but we do find that it is significantly more likely that the auditor resigns from being your auditor. We find that in the event that they don't resign, 2 things happen. It takes them almost twice as long to conduct the audit. That's suggesting that they're doing more due diligence, right? If you've signaled that you're lying in your personal life, then I'm going to check and double check and triple check, so it takes me longer to do the audit. And then even adjusting for time, the price that they charge the company for the audit is substantially higher.
That's interesting.
And that's suggesting that risk is being priced because their reputation is attached to that firm now. If you're signaling privately that I can't trust you, I may just sever the relationship, but if I don't sever that relationship, I'm going to spend a lot more time and I'm going to charge you more because implicitly at least, it seems that they're pricing that risk.
Do you find there's any difference across the categories, so across the indiscretions for, dishonesty versus...
Dishonesty is still strongest.
Okay.
And I think it goes back to the accounting book. So ultimately what the auditors are charged with is verifying the accounting information.
Okay.
Right?
Yeah.
And so ultimately it makes sense. And it's really still the same reason that we spoke of earlier why shareholders should care. This is the conduit of information that goes to shareholders. That's what auditors are charged with. And so, dishonesty.
Okay. I think that makes sense. So can you use this information again, or how else have you used this information to be able to understand firm behavior, individuals within the firm and their behavior? So I know that you have great research analyzing insider trading and legal and illegal insider trading and SEC enforcement and involvement. So do you have any idea in terms of, using the personal indiscretions into, say, the insider's trading behavior?
Yeah. Well, one, we use it directly to determine whether or not we invest or don't invest in those firms. And so I use that personally. I run a student managed portfolio at Mississippi State, and we factor these types of information into the companies that we invest in.
Do you personally also look at this when you're doing your own? And oh, wow. Well, that's very interesting to know.
And then more directly to your question, Hao Young Ching, who was one of our grad students at Mississippi State, is currently on the market, has done some research with myself using this data. And the question that he raises is, are insiders who have been accused, so any insider being top managers who have to report their trades, are these insiders who have shown their willingness to be dishonest or have these lapses of integrity, are they also tend to make more money on their insider trades? And so their argument is that, especially with insider trading, in many cases, you have private information. You know you have private information. It's clear you shouldn't trade on it.
Okay.
Right? In other cases, you have just some priors about whether the company's stock is going up or down, and there's no private content to that information,
Okay.
and you know you're free to trade.
Okay.
Everything else kind of falls in a gray area. You have a little bit of information, but it's not completely private, but maybe it could be perceived as private. And so at the very least, if an insider is willing to lie, cheat, or steal in their personal life, then they may be more apt to take risk and be more aggressive on those trades that are in that gray area.
Okay.
Or in a worst case scenarios, they're outright willing to trade illegally. And so his idea was to look at the trades of these insiders that have we are aware they're engaged in this bad behavior on the personal level. Do they tend to be more profitable? And he would argue, theoretically, they should be more profitable.
So, but I mean, again, we can think about it on the flip side that if you are willing to take risk in your personal life, so if we categorize certain indiscretions as just more risk-seeking behavior, gambling, drinking, substance abuse, obviously to an excess can also affect your behavior at the firm, but that also is signaling more risk-seeking behavior. We could understand how that would also affect your trading strategy, and it's not necessarily that you were doing it because of private information. Your personality is to be more risky in your trades. Does that make sense?
That does make sense. That makes a lot of sense. I think the difference with our sample in that there is risk where you're just willing to experience a larger downside potential loss for the higher likelihood of experiencing a big gain. That's how we tend to think of financial risk. The difference in our indiscretions is, sure, it still may be a risky type of behavior, but all of these instances harm someone else, whether it's violence or substance abuse or dishonesty. All of these are risks that you're not, in an investing perspective, willing to take personally a higher upside, trading off with a chance of a higher downside. In our cases of our indiscretions, you're imposing that risk on others for you to take the benefit. And I think that's how that maps with insider trading.
Okay.
If I have private information, then I'm willing to, I know that the downside is very, very small, right? I'm not necessarily taking risk. In fact, it's just the opposite. If I have true private information, I know the direction of the stock price. And so I'm not necessarily taking risk. I'm getting a bigger upside. So if we were to measure it like we do around returns, as of the variance of returns or whatever, it would look like the investments tend to be more risky. But we're forgetting the fact that they are risky in the sense there's big ups and downs, but if it is private information, they know the direction.
Okay. Yeah, I think that is understandable. That makes sense. So when, again, so you've identified in your sample insiders who have been publicly announced as having engaged in one of your categories of an indiscretion, correct?
Yes.
And then what do you do? Or how does How Young within this research kind
We look
of...
at all of their trades, both historically and before and after the indiscretion.
Okay.
And we just want to know, on average, are they profitable? Are they more profitable than other insiders that are comparable, with the exception of we don't have a known indiscretion?
Okay, that's what I was going to say is how can you say they are trading on private information, because we don't know that either.
Well, you're exactly right. We really don't know. So it's common in that literature to measure the performance around these trades. And we have what we call abnormal returns.
Okay.
And so we're adjusting for risk and market and time and all these things to generate what we call an abnormal, or another term is excess return.
Okay.
It's a return that exceeded what would be expected for taking that amount of risk. And so we end up implicitly assuming that if me, Brandon Cline, if all of my trades tend to make abnormal returns, they beat the market on average over and over and over again, then we would consider that my trades have private information.
Okay.
You're right. I may not have been illegally trading on private information, but I'm beating the market over. So there must be something private that I'm either just getting lucky over and over again, or there's some ability that I have to beat the market.
And these insiders who have personal indiscretions, do they beat the market?
They do. They significantly, at least in the period before the public announcement of the indiscretion.
Wow.
So if you go back, they both, well, I won't go into all the different types of tests, but it is both economically and statistically significant that they overwhelmingly beat the market before the indiscretion. What's interesting, going back to one of your comments before about the market disciplining, we observed this here as well. If you look at these same insiders, after the public announcement of the indiscretion, the abnormal returns go away. So in essence, that they haven't been caught for insider trading. They haven't been punished by the SEC. Nobody has mentioned their insider trades. But what we see is that they were, I guess, to give you the full picture, they were engaged in personal bad decisions. They were willing to be more aggressive on their insider trades, and that allowed them to beat the market over and over and over again, in which we would again assume they were trading on private information.
Okay.
After the announcement, once it's publicly known, they go through a lot of shame. In some cases, they do lose their jobs. They get demoted. Their pay goes down. All these things happen to these executives on average. Thereafter, their abnormal returns cease.
But if they do lose their job, then you wouldn't have that test.
Well, what's interesting is they tend to go to other firms.
Oh, wow. Okay.
We're able to track these both. And that's actually, I won't get into too many of the details, but there's this whole debate over whether or not insider trading or other types of bad behavior is personal or whether it's more cultural within the firm.
Okay,
and so one interesting thing from Hal Young's research is he is able to parse out by looking at these guys that stay at the same firm versus go somewhere else that is actually not as much cultural, it's more personal.
Interesting.
An insider who engaged in that behavior, suppose that I got caught for an indiscretion, but I've been at 5 different firms for the past 20 years. He looks at each of these firms, and if they were profitable at one firm, they tend to be profitable at the other, and they tend to be profitable at the next.
Wow, that is very interesting.
So we're not saying that corporate culture doesn't matter, but at least the dominating factor, when we include both of these in a simultaneous model, the aggregate corporate culture is mitigated by the characteristics of the insider themselves.
Wow, that is fascinating. So since we have a little bit of time and we're on the topic of insider trading, and I know that you have a large body of work in this space.
I should mention, actually, that both the first paper, Adam Yore, when we collected the data, Adam and I had collected the data from the very beginning. I mentioned Hal Young because he was in one of the later, but without Adam, the project we would not have probably initiated or much less gotten as far as what we have. And so Adam is also a co-author on each of these papers that I've been discussing.
Yes, and I know Adam, and Adam's a great researcher and a great friend.
He's very good.
And he's at the University of Missouri?
That's correct.
Okay, I thought
correct.
So. And he has tenure there now?
He does.
That's wonderful. Always good. You probably mentioned Hal Young because he's very much on your mind since you're trying to get him a job.
That's correct. He's doing well.
And so one of your other students who's recently placed at the University of Alabama at Birmingham, Caleb Houston, and you have a paper that you've been working on, and it is, I believe, a revise and resubmit at the Journal of Financial and Quantitative Analysis, the JFQA. Well, congratulations again.
Thank you. I'm very proud of that paper and very proud of Caleb as well. He was another exceptional student. I've been fortunate.
Well, that's been fantastic. So why don't you talk about, my understanding of that paper is you're looking at insiders and when they don't report their trades. Is that correct?
Yeah, so just a little bit of a background here. So the way we're able to do the analysis that I was just describing in the Hal Young paper and look at trades is because legally insiders have to report. So by insider, if you own 10% or more, the SEC requires that you can trade, but you have to disclose those trades. Or if you're just any insider of the firm, any manager or employer of the firm, you also have to report the trades that you make in that company.
So say that again. So if you have 10%, you have to report?
10% or more. So you can be outside the firm. So if I'm a significant investor defined by the SEC as owning 10% or more, you have to. Or any actual insider of the firm. If I'm the CEO or director or whoever there's some likelihood that I would have that private information, I have to disclose my trades, whether I own 0% or...
Would the CEO secretary who may see the emails and memos, and would that count? Because I know that in some of the insider trading cases that have been made into movies and books.
There's a lot of lower level executives that do require. In fact, even sometimes beneficiary owners, that says owners through a trust. And so it would surprise you how many actually do have to
report. At least they're supposed to. But what you guys are uncovering is when they don't actually.
Yeah. So what's odd with these is that prior to Sarbanes-Oxley in 2002, you had a fairly lenient reporting window. And so if I traded and I'm an insider, I have to report. But prior to SOX, prior to 2002, I could report up until the 10th day of the month following trade. So, for example, if I were to have traded on November the 1st, I wouldn't have to let the market be aware of that trade until the 10th day of December. So up to 40 days could have passed before. And so the idea is price transparency, right? Insiders tend to have information, and at least derivatively, it's really good for markets for that information to be signaled through their trades.
Okay.
And it's beneficial for shareholders who have private information to hold that monopolistically, right? You don't signal. You trade on it as much as you possibly can before the market is aware. And so after Sarbanes-Oxley, the SEC tightened that legal window that you had to disclose that trade. So in other words, you could keep it hidden up to 40 days before. They tightened that to 2 business days. And so now if I were to make a trade today, I would have to report that by the 3rd business day, or else that trade would be delinquent. It would be late.
And what would happen? What is supposed to happen?
Well, what is supposed to happen, there will be some actions taken by the SEC.
Okay.
And there are rare instances in which they have. What's interesting is that leading up to SOX, they were very vocal about the need for shortening that disclosure window for the reasons that we mentioned. Shareholders should be aware was the argument. But what's also interesting is that there's been a vast amount of insiders that violate that, and there's no actions taken against them.
So the SEC would be aware, is that correct?
Oh, sure, because in this sample, at least, we don't know how many people never file. We have cases where they do file, they just kept the information private longer than what they were supposed to. So on average, they were supposed to report 2 business days following the trade. What we find is the average of the sample of those that violate is 37 business days. So about a month and a half, they withhold the information contained in that trade from hitting the market. And so why would they be willing to do that?
Why would they be willing to do that?
So there's several. One is private information. So I want to maintain that monopoly, own that information. As soon as I trade, so in other words, if I'm an insider and I have information that I'm willing to trade on, there's reasons for me to split this order flow up. I don't want all a million of my shares hitting the market, because as soon as it does, I'm going to have a higher likelihood that's going to raise red flags, right, from my shareholders, from the SEC. And so insiders tend to bust these orders up. Well, what I don't want is information from my first order impacting the price. So suppose that I'm going to buy 10,000 shares for the next 10 days, right? And so I buy 10,000 shares today. I'm an insider. Investors are watching my trades. If I buy 10,000 shares today, the price is going up. Not just because I'm buying shares, but derivatively, the market's saying, oh, Cline, CEO of company X, must know something. I'm buying too.
Right.
Well, that hurts me tomorrow because I want to buy 10,000 more shares. And then they see me buy 10 more thousand, the price goes up more and more. So what's happening is I'm adversely affecting the price that I'm going to receive on the stock that I'm trading. And so what I would like to do is bust that order flow up over 10 days, but not report any of these trades until after I've executed all of them. And that's what we call trading in stealth. I'm trading, nobody's aware of it until I'm done trading. I'm under the radar. I've camouflaged all of these trades.
So why isn't the firm more either aware, or if they know this, why don't they take it upon themselves to make sure that they're complying with the law?
I think, but maybe because there's been very little done with those that have violated it. In fact, what we tend to find is these types of violations cluster by firm. So if a firm has one insider who has a history of reporting their trades delinquent, they probably have more.
They probably have more insiders that are not. Okay.
Yes, and also across time. If 3 years ago your insiders of your firm were reporting delinquent trades, there's a much higher likelihood that their current trades are also being reported delinquent.
And so again, it's more of just the insiders benefiting themselves. Is that how we would classify this? They're keeping the information private. They're keeping their trades private because they want to personally benefit.
I think that's true. So we also examine earnings restatements.
Okay.
There are some situations where it would also be advantageous for the firm to keep them private as well. So during accounting fraud, if I know that the stock price is being propped up, I would like to trade on this to earn abnormal returns. But particularly if I'm the company, so we differentiate company versus CEO, but ultimately there's 2 or 3, 4 people that are making most of the decisions in the company.
Yeah.
So the same individual who's deciding to commit accounting fraud is also deciding whether or not they're buying or selling shares as an insider. Right? So knowing that I'm committing accounting fraud and knowing that the stock price is propped up, I would like to be able to capitalize that within my personal portfolio. But what I don't want is the signals from my trades signaling that this price that you're observing isn't a realistic price. Price is being propped up because I don't want to signal my own fraud from my trades.
Yeah.
And so I would have incentive there, both at the individual level, and the company would also have incentive to cover those
that
trades
up.
And so what we find in those cases is a little bit different from the stealth trading, but over the accounting restatement period, insiders trade. They don't report these trades. Once they get caught for the accounting fraud and they have to restate, they then go back and report their insider trades as well.
So have you looked to see any of the delinquent filings if those individuals are in your indiscretion sample?
I haven't. That's actually a really, really good, and I've talked with that to Caleb, but no, we have not.
Well, that would be, I think, a great even if it's more anecdotal.
I think that's a very good question. Maybe we can start a paper on that.
That's right. Absolutely. Well, I am very excited that we had the opportunity to sit down and talk to Dr. Brandon Cline, Finance Professor at Mississippi State University. Thank you for joining us for the Probasco podcast.
It was a pleasure to be here. Thank you for allowing me to share some of my research, and I appreciate the interest.
It was fascinating research, and again, I think that what your work, not just on integrity and indiscretions and insider trading, but your overall body of work shows how relevant academic research can be when we don't always see that coming out of academic research. So I find it highly enjoyable to read and invite others out there to make sure that you're following Brandon Cline's research. And again, thank you for joining us.
Well, thank you again.
Okay. Bye-bye.